Hey everyone, welcome back. I'm Jeremy Szafron. It's a volatile day in the markets as Washington careens towards a government shutdown. So far, the president says it's likely, but of course this is a developing story we'll continue to follow. And you can see the reaction right here in the price of gold. A sharp spike this morning as investors run for safety, now pulling back a little bit as traders digest the news. But this isn't just about gold. The market is sending a very clear and conflicted signal today. While gold is up, industrial metals, the lifeblood of the real economy like silver, platinum, and palladium, they're all under pressure, and it's as if the market is betting on monetary chaos but is deeply worried about a genuine economic slowdown. Now, this all comes against a deeply conflicted backdrop on the economy here. We just learned consumer confidence has hit a 5-month low with people worried about their jobs, and that's no surprise when you look at the latest JOLTS report showing hiring is declining, confirming the trend from last month's dismal jobs report. And of course, to help us break through all of this noise, we're joined by Mike McGlone, Senior Macro Strategist over at Bloomberg Intelligence. Also Commodities. I must say, Mike, good to have you with us. Thanks again for joining.
Oh, thanks for having me back.
Let's talk about this, this great divergence that we're seeing today. Gold is up, copper and crude oil are weak. Now, you've called this a signal of a profound reversion cycle. Unpack this for our audience a bit. What's the market telling you right now?
Gold is getting really scary, approaching $4,000 an ounce, up 46% in a year, the best year since 1979. I was only 15. I remember that one. Yeah, well, I wasn't trading then, but it's just a significance how much it's doing it. But it's basically virtually all risk assets, most notably stock market, are underperforming gold this year. And you mentioned some other ones, all the industrial precious metals. Remember, there's four precious metals: gold, silver, platinum, palladium. Now they're catching up versus gold, but the signals are quite disconcerting. The key thing I like to point out is we're seeing this record run in gold, nearing that major threshold. I think it's just a matter of time it prints that 4,000. Markets might run numbers, but it's happening in an environment with volatility in the stock market about as complacent as it's been in 5 years on a 60-day basis. That's very rare. So when you get volatility that low, the lowest 60-day volatility S&P 500 is running below 9%. Again, it's worse before COVID. There's little room for it to go up, particularly as we enter that volatile time of year. And we're just ending the slow period time of year. And gold might be front running a little bit of some issues. So what I'm just looking at happening is gold right now, I think, is stuck between 4,000 and 3,500. 4,000 is significant resistance. I just went back and looked at decades, years, even, depending on what days. It's such a stretch from any normal moving averages for heading higher that for it to get above that level, it's similar to a lot of peaks in the past. The most like one I really like to compare it to was when we hit 2000 and 2020. That peak lasted for 4 years. And then it's got that good level of support down 3,500. That was April's low. So I think it's stuck between this level for a while. And in Q4, it can test both and really not matter too much. But the big picture is what the stock market does.
Yeah. And let's talk about that thesis because it seems to hinge on that key catalyst, right? A stock market correction. I mean, you said gold might need that little blimp to really kind of take off.
Yeah.
Right now, you see it. I mean, the S&P 500 is resilient, fueled by this AI narrative. The S&P 60-day volatility is near its lowest since before the pandemic. What if the stock market doesn't roll over? If we get a soft landing and equities continue to grind higher, I mean, does that create the major headwinds you're talking about for $4,000 gold?
Sure. Well, it's if the stock market doesn't roll over, stays resilient, volatility stays low, we do same old stuff, easily gold could 8 to 10% get right back down to that 3,400 level. It's still up a lot in the year. I mean, that's well over a third, which puts it in the top like 8 of the last 100 years on an annual basis. And that's just how far stretched it is. But what's really happening significantly lately is this major shift to inflows and gold ETF inflows. So gold ETF total inflows now, our measure on the Bloomberg says they're up almost 20% this year. To put that in context, the last 4 years, there were outflows. So that's switched very positive. And the last time we had a really good inflow year was 2020, and they increased almost 30%. So we're on a pace as 2020. But what happened in 2020 was a major shift in the global world order. We had COVID kick in, the biggest money pump in history, and volatility spiked. Now it's the opposite. We're getting, another shutdown, kind of getting used to that in the States. We have the thing I want to mention, I think most notable, is that gold just loves President Trump. His nuances are wonderful, and gold, every time he says something, I think gold smiles.
You've also noted that from a positioning standpoint, I mean, the gold trade isn't crowded. You just kind of talked about it. Managed money net longs are still well before that peak. I mean, couldn't that be interpreted differently instead of maybe seeing it as room to run? Could it be a sign that the smart money isn't fully buying into the rally yet, perhaps waiting for a deeper pullback before committing?
That's a good point. So I'm glad you manage money net positions. Their total right now, about as far as COMEX open interest, is about a third, maybe 33% of total open interest. Last year's big run up when we first started getting towards that 2,600 level, they got up to 45% of open interest. That's about as high as it gets. So those overweight longs are way curtailed, and it's shifting more to long-term investors. But that's just a good way to measure. I think managed money net positions are just a good way to measure where you might get excessive bullishness and where you might hit stops if the market rolls over a little bit. But the bottom line is the deepest pockets on the planet are still buying, and that's central banks, and they're a lot harder to measure, particularly as you see the war escalating and wars escalating in Europe. And things like Mr. Trump are saying that we might, encourage Ukraine to take back some of their land. This is just it's almost a perfect storm for gold. But I point out long term, all those indications I have, you go 4,000 anytime soon. It's such an overbought level. It's not a level for most investors to be laying into new longs. But I'm concerned of what it means for the macro, and that's potential. Just the potential. Here's the key thing I'm worried about. Just a little bit of minor reversion in S&P 500 volatility. So right now, the VIX volatility index is running 16%. The average for the year is right below 20. Say we pop up to near 20, kind of means nothing in the big picture. And the thing is, do we stay above it by the end of the year? And that's why I think the fourth quarter of this year is going to be significantly telling for what might happen for the next few decades.
Yeah, wild.
I should say.
Yeah, next couple of years. I mean, looking at some of those charts, have you seen this type of volatility? I mean, even on the gold front, watching this, it has a little people waiting for maybe a little breath here.
Yeah, so we're overdue for that. What's the spark? And like I said, typically I go to manage money net positions and I look at the ratios, Jeremy. And it's really kind of scary. You look at right now it takes 61 ounces of barrels of WTI crude oil per 1 ounce of gold. The highest close ever at the end of the year was 39. And those 2 years were 1933 and 2020. Not really good years for markets. So things like crude oil going down and gold going up on a global macro basis, that's a very scary indication. And it just shows there's no demand pull for the world's most significant commodity, yet there is for the ancient store of value. And then what's stuck in between there's most of the other metals, particularly copper. And the question I'm really watching is, can copper stay strong into the end of the year? Yet it's kind of being pumped up for, I like to say, the wrong reasons. Potential supply disruptions and actual supply disruptions.
Yeah, and some of those fundamentals, I mean, you've been bearish, calling recent strength a kind of a spike to sell and warning that it could follow oil lower. But Mike, I mean, there's a powerful bull case, as you mentioned, right? That massive supply disruption at the Grasberg mine in Indonesia. It almost feels like it's completely flipped the market dynamic. I mean, Goldman Sachs just shifted their forecast from a surplus to a deficit for next year because of it. Bank of America is now forecasting a 350-ton deficit and prices above 13,000 by 2027. Are you concerned that your recessionary demand forecast is kind of underweighing that could be a historical supply squeeze in copper? Could Dr. Copper be wrong this time?
That's the thing. It's making its relevance as an economic indicator less significant. But these kind of supply disruptions usually are temporary. My colleague Grant Sporey, who covers this stuff more depthly out of London, points out typically you get a 5% issue in copper supply disruptions. This year is closer to 10%. But I like to talk about the elephant in the room in terms of copper. Copper is known as the economic sensitive commodity, and on the year it's up about 20%, and the S&P 500 is up 15%. You see, it's riding that wave. Copper was up for a while, almost a third. It dropped back, the tariffs, and now it's just riding that wave of beta. So that's the key thing: is beta has to stay strong. So the elephant in the room, I think, for copper, crude oil is already tilting lower, is the stock market has to stay resilient. And then I point out, well, the risks are that might just have a little bit of a back and fill by the end of the year. That means all the dominoes tumble, but that would just be following things like crude oil. And then there's key things about really indication for copper, and that's 1.87%. That's 10-year note yield in China, severe deflationary forces. And you look at the price of iron ore, it's heading lower. Those are typical companions with copper to go higher, but they're heading lower. So my point is, if this volatility in the U.S. by the end of the year just kind of picks up a little, U.S. stock market, the dominoes tumble, and copper is the number one to watch for potentially just dropping with crude oil, iron ore, and bond yields in China.
Yeah, interesting. Okay, let's talk about the other side of that divergence. You've been very bullish on your call for crude oil. We've had you on the show. We've talked about it, saying it could revert towards that $40 a barrel.
Yeah.
Obviously a little bit of a drop here. It has been on the downward. What makes you so confident in that deflationary outcome for energy when, OPEC Plus is actively cutting supply and we see these geopolitical risks everywhere?
Well, that's the key thing. Crude oil and the grains are in the same bucket. They're in the
Yeah.
low price cure trajectory after pumping up too high to those spikes in 2020, 22. That's usually what happens to commodities. Commodities go down towards low price cures after they go up too much. They're in the same bucket, and there's not really much to stop it right now. Also, in the middle of this significant technology revolution. Why does the U.S. under the Biden administration have to institute 100% tariffs on EVs out of China? Because there's massive supply of these wonderful vehicles that use no petroleum and use electricity and are just shifting the world order. And then there's a key little fact about crude oil. The last 20 years, there's been 3 lows around 40. And that's since the peak in 2008. Copper kind of looks similar to 2008's peak. And I just like to point out, it's not profound to look for a normal reversion in a commodity to go below its break-even cost to offset excess supply and demand, which we have in crude oil right now. In the last few years, it's been around 40. But we're also seeing that major shift. And that's why I think everything tilts on what's holding crude oil up. It's like $62 a barrel right now, WTI, which is below last year's low. It's 65. If you see the bent there, is the resilience in the U.S. stock market. So that's why I point out is if that we get a little volatility pickup in Q4 in stocks, the dominoes already tumbling in commodities. Look at crude oil, and that's where copper's all in the same space. So the difference is crude oil is just more significant, but it's also being replaced by technology. Part of that technology is a demand pull for copper. But when I think of like electrification, let's talk about the most the best conductor of electricity of all commodities. That's silver.
Yeah, well, let's talk about it. Our audience is watching silver, as you know, very, very carefully. We watched a little bit of this dip today while gold's up, but you've been less optimistic on silver, expecting it to kind of lag gold in a recession due to its industrial side, right? It just hit its 14-year high. Where are we at?
Well, so that's the key fact. Remember, silver is known as the devil's metal for a reason because it trades 2 times the volatility of gold. So on a 1 to 2 year basis, it's up a little more than gold, 60%, and 1 year basis, gold's up 50% or so on a 1 year basis. That's a bad sign. When you get almost the same performance at double the risk, it's not a good sign. So I look at silver and still bullish silver. I think it's probably put in a pretty good support level around 40. It's probably going to make a new high around 50, just a matter of time. But it's in a similar bucket. Every day it goes by, it's much more industrial. In a similar bucket is copper and platinum and palladium. They're all following in that space in precious metals. Remember, there's 4. They're all following beta in gold, and central banks aren't buying anything other than gold, but they're catching up. It's a question how far, and they also face competition from things like cryptocurrencies. But the difference is, I like to point out, most of these precious metals, a basket of these precious metals on the year up almost 50%. And you look at a basket of cryptocurrencies, they're up maybe 10, 20%, yet they trade 60 times the volatility. So what you're seeing there, I think, is gold leading all the precious metals higher. There's only 4 of them. And then you've seen Bitcoin leading some of the cryptocurrencies higher, but there's millions of those. And there's so unlimited supply is going to always pressure the prices.
Hey, with silver, silver hitting that 14-year high. Is it possible when we kind of come back, its monetary characteristics could kind of dominate? In a true crisis, do you think silver's higher volatility mean it actually outperforms gold to the upside as retail investors rush in?
In a demand pull economy, when you have a country like China, who creates most of the silver panels in the world, really expanding economically or not, they are completely pumping their system to stay afloat. There's debt to GDP is running 300%. Money supply is running $45 trillion, almost more than double the U.S. So it's a severe deflationary force there. And silver is just reflecting that potential global tilt towards a recession that you're seeing in crude oil. And then you have to ask yourself, when's the last time we see some substantial upward revisions in global GDP estimate growth? So right now they're still facing this paradigm shift of tariffs from the world's largest goods importer, the U.S. And so silver's stuck in the middle there. It's in the same bucket as copper. And I think that's why I'm worried that if we get a pickup in volatility, all the metals on the planet that are much more industrial than gold will suffer, continue to compare to gold, and they're only really rallying because gold's making them go higher. And again, there's substitutes. I mean, silver's for jewelry, platinum plating can be used for jewelry. So when you get the price of platinum to the lowest versus gold in, I think it was May ever, and the gold to silver ratio got to 105 in April. That was really high. Now we're down in the lower end of the range around 82. That's just, they're all in the back of gold right now. Almost all the metals.
Yeah. Let's look at the bigger picture. I mean, you compared the current setup, record high stock valuations relative to GDP, kind of diverging commodities to a major historical peaks like 29 in the US or 89 in Japan. Obviously, a little bit of a warning here, Mike. I mean, what does a profound reversion cycle actually look like for the average investor? Are we talking about a sharp, painful crash or a long, grinding deflationary period like Japan's lost decades?
The answer is yes. I don't know, but I'm waiting for indications of that, and that's why I think fourth quarter are going to be so telling, Jeremy. You basically need stock market volatility stay at a 5-year low. Okay, first for that to keep this, the wealth creation machine going, and that's where gold's warning there's a problem. So I think the risks are that one thing that's really striking me, if you look at things like the ratio of gold in terms of U.S. Treasury prices. Now, for bond prices, we can always go back 40 years. But if you look at an aggregate measure of Treasury prices, you have to go back to 1983, the last time that Treasuries were this low versus gold. That's pretty extreme. And this is a little reversion. And the other side of that, you look at the stock market cap to GDP in this country, it's the highest since 1929. So a little bit of reversion there is maybe what gold's figuring out. It's this question of how it happens and when. And to me, that's what I see. I see gold as just plain scary at these levels. It's just telling us there's something might be going on. And also it's getting really expensive. So a good example, 2008, gold rallied basically 30% in 2007. It pumped up a lot in 2008. And then when we hit, things really collapsed in 2008, gold dropped 20% initially and then recovered. So it's, that's why I'm worried that there is, it made you live in interesting times, and markets are so extreme that you have to be careful. Like just talking about 4,000 gold up almost 50% in 1 year, with the stock market fine is kind of, and with inflation still kind of, a lot high, 3%. So good examples. The last time we had this kind of rally in gold in 1979, inflation was running 10%. And this year it's running below about 3%. That's CPI.
Yeah. It's going to be interesting. All this while Bitcoin's sliding a little bit. It's almost been reinforcing its status as a risk-on asset correlated to the NASDAQ, as you've called it. But the bull case for Bitcoin is it is a hedge against this very fiscal and monetary excess that you're describing. Why do you think Bitcoin's failing that test right now? And what would it take for Bitcoin to finally decorrelate from risk assets?
Lower prices. Bitcoin. Unfortunately, I fully expected it when it was around 10,000 in 2020, when there was a lot of crying in that space to go to 100 grand. It added a zero. Now that there's a lot of yelling, should expect selling. It's just classic indication of a market that's gone too far. But remember, its correlation in cryptos to the stock market is the highest ever. I look at 48 months because it's a 4-year cycle. It's around 0.6. In 2020, it was negative. So it's clearly, the whole crypto space is clearly a risk-on space, and gold's clearly a risk-off space. Yet the stock market's still up 15% of the year. So my point is, if we just give back some of those gains, you're going to see the truth about unlimited supply, massive hubris, and speculative excesses that reminds me of the internet bubble in 1999 and 2000, just many times more. And the key thing I like to point out is when you track a number on the screen that shows you the price of gold or futures that tracks the price of gold, it tracks a basis. You can always trade that number, if it's futures, against the actual physical gold. And there's a basis there. In vast majority of cryptocurrencies, there's no basis, except about 300 million and 300 billion, that is, in crypto dollars or stable coins. Everything, all of them are just full faith and a number on the screen that things like Dogecoin that trade 40. The value right now is 28 billion. At least that's coming down a little bit. I'm sorry, Dogecoin is 34 billion. That tracks nothing. It's just full faith. And that's my point, is when you start seeing a little backup in the excessive valuations of maybe U.S. equities, first place to get hit, first place to probably get hit might be cryptos.
Yeah, well, speaking of those evaluations, I mean, NVIDIA is in an incredible run today. It's in record territory. Officially became the first company in history to hit $4.5 trillion in market cap. I mean, Q4 is going to be interesting. It comes back to this thesis. Let's bring it kind of together for the audience as we go into that fourth quarter with this whole government shutdown looming, the stock market that feels complacent and these major divergences in the commodity space. Just how important is Q4? I mean, what's the single most important chart or ratio that investors should be watching right now to know where things are going or if they're going to break?
Well, one of my favorite ratios I've watched for over a decade is Bitcoin to gold. The ounces of gold equal to one Bitcoin. Right now, it's 29.5. The high when President Trump got elected was 40. The low this year is 25. To me, the risks are that this goes back below 25 as we find out that this has been a great leading indicator for the stock market and risk assets. So to me, that's a top ratio to watch. And it was way too expensive. It got to 35 recently, back in July when the VIX was very low. And now it's trickling back down as we head into fourth quarter. So it would be wonderful if we can end this year and say the VIX at 16 and still is around 16. I'm worried it's going to go back above 20. It'd be wonderful if we can keep those trends going, but we're heading towards the reality of late cycle things. And then the discombobulation of Mr. Trump, the pushing back on the Fed. Gold loves that. And the tariffs. I mean, the whole world is facing recessionary trajectories. As I mentioned, China, just look at Germany. 50% of their GDP is basically exports. So to me, this is, so that's the scenario. If things stay boring, that's great. Then I don't know what to do. But if we get just a little modest pickup in volatility, that could set the tone for years. And unfortunately, that's why I tilt over to copper. It looks to me very much like crude oil did in 2008. It popped up to a peak in July. It got hit down by end of Q3, and then Q4 it collapsed down to 40. Copper's kind of hovering there right now, and you can see how it's basically hovering with the stock market. So copper's a great leading indicator. And then you look at gold versus everything. It's basically made a new high versus broad commodities versus copper versus crude oil, and there's only one thing it's still relatively cheap against: the S&P 500.
Yeah. Wild out there. I was reading on X today, obviously China is going into this 3-day national holiday and some of these markets are closing. A lot of people saying go and buy the dip on the gold side. Did these small moves actually make an indication where you're sitting?
No, in fact, I try to do. I put up my DI list to deliberately ignore. As an ex-trader, it's so nice to be able to ignore those things, because I remember getting stopped out on the wrong side of a lot of that stuff, and having clients getting, it can really cause a little disconcert. It can be mentally and physically and taxing on your time, treasure, and talent. I look at the macro big picture, and gold's in a raging bull market. It's just getting overbought. That's what happens in bull markets. And last year was below 3,000. That was probably a time to be overweight, and it's proving that this year. But getting near 4,000, it's probably not the place to get overweight. But that's typically what investors do. They pile on their peaks, and I just look at 4,000, such significant resistance that if I'm right about this, volatility potentially picking up in the stock market, and gold being so expensive, the next big potential trade has been one of the most beat up markets on the planet, and that's good old U.S. Treasury bonds. Good old treasuries. I mean, still interesting. I would have 4%. I mean, it's not bad returns on that front. I mean, gold's not really giving you any residual back on that front. Well, that's the thing. It's what is gold telling us? Is it a feint? Is it a false move? Unlikely. If it really collapses by the end of the year and trades below 3,400, it might indicate that. But I think it's more likely it's just going to be like this U.S. 10-year note at 414 is going to just kind of follow what we have in China right now, 1.87, and just reminds me of trading JGBs 30 years ago. That's what happened. JGBs collapsed. It took a while. Japanese government bonds, I should measure. And then it was just a matter of time the rest of the world caught up. And now that's kind of tilting the other way a little bit. Yeah. All right. Mike McGlone with Bloomberg Intelligence joining us today. I appreciate it. I mean, this could go right out of the window if we stop pressing record and we have somebody coming in and preventing this government shutdown. But right now, obviously, an interesting macro backdrop, huh? Thanks for this. Yeah. Thank you. All right. Thank you for your time and insights. Of course, we're going to let you know you can follow Mike on X, and we'll have a link in our description. Now, that's all the time we have. Stay tuned to Kitco News for continuing coverage of this shutdown and the impacts on the markets outside the mainstream narrative. I'm Jeremy Szafron. We'll see you next time.